a limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to Business Standards Banking Show. I am Ruchika Chitravanshi. In today's episode, we will talk about systemically important banks and if there is a need to revisit the way they are defined. For our Bankers View this week, we have with us Rustam Irani, Managing Director, Hitachi Payment Services. Why have floating rate bonds become a headache for the government? We will answer this for you in Banking for You. Tamal Bandyopadhyay joins us to talk about his expectations from the upcoming monetary policy. At the end of the show, we will share the results of our last week's poll and tell you the question for this week. Keep watching. Some of the recent developments in global banking have raised a question about systemically important institutions. The term itself could be a matter of review by the Reserve Bank of India. Raghu Mohan tells us more.
The dramatic collapse of the Silicon Valley Bank and Signature Bank in the US, followed by Credit Suisse's troubles in Switzerland, have underscored new risks to global banking. These developments may also force a rethink on systemically important institutions. In India, the Reserve Bank, or RBI, releases a list of domestic systemically important banks, or D-SIBs, every year. The one released this year remained the same as last year. State Bank of India, or SBI, comes in at the pole position, followed by HDFC Bank and ICICI Bank. But the order of banks by asset size has changed after the government merged 4 sets of state-run banks in 2018, while SBI and HDFC Bank continue to occupy the top 2 slots. Bank of Baroda and Punjab National Bank come in next, with ICICI Bank following them at 5. Is it time to relook at the D-SIBs rostrum? The matter is said to have figured in internal meetings of the RBI's supervisory department after the merger of state-run banks. In July 2014, RBI released a framework for dealing with D-SIBs, which said the methodology for assessing the systemic importance of banks and identifying them will be reviewed on a regular basis. This review will be at least once in 3 years. Moreover, the D-SIBs framework said nothing about keeping the number of systemically important banks at just 3. Even in 2014, the RBI stated that this list may have 4 to 6 banks in various buckets. Here is what Ravi Duvuru, partner at Duvuru & Reddy and a member of the second Regulatory Review Authority set up by the RBI, has to say.
If you look at what has happened recently in the SVB Bank case, SVB Bank is not rated as systematically important bank, and it was not put through the stress test by Fed Reserve. Yet it collapsed, and it could have led to a contingent effect, but thanks to the timely intervention of the regulator, it didn't happen. But if you look at the whole concept of systematically important banks, the criteria basically is on the leverage ratio based on the Basel principles and the percentage of the GDP ratio there. However, SVB did not fall under that. So it's important to look at the criteria, especially I think there should be a criteria with more weightage on payments transactions. If a bank is undertaking critical and high value payments, it should be deemed as systematically important too. So there is a need to relook at the criteria by the RBI and also the regulators across.
And what about the risks from the exponential growth of the payments business? Fintechs have played a significant part here, and they have partnered with banks. Or what about the risk from supporting entities that enable payments, like the NPCI or even account aggregators?
These payment systems architecture is very critical. NPCI, CCIL, very, very critical in terms of supporting architecture. So I think we need to relook at that and what are the systems in place to ensure that there's no disruption.
In October 2010, the Financial Stability Board, or FSB, the body that monitors and makes recommendations on the global financial system, recommended that all member countries have a framework to reduce risks attributable to systemically important financial institutions, or SIFIs, in their jurisdictions. The Basel Committee on Banking Supervision, or BCBS, later came out with a framework in November 2011 for identifying the global SIBs, and its members to have a regulatory framework to deal with D-SIBs. It has been nearly a decade since the RBI came out with its D-SIBs framework. Perhaps the time has come to review it.
Raghu has raised a very important point about the risk posed by the exponential growth of the payments business and even the supporting entities that enable payments. Talking of payment services, in our next segment, we have with us Rustam Irani, Managing Director, Hitachi Payment Services. Irani spoke with Manojit Saha about the deployment of white label ATMs in semi-urban and rural areas.
Hello and welcome to the Business Standard Banking Show. Hitachi Payment Services, a 100% subsidiary of Hitachi Limited, has around 28% market share of ATMs deployed in India. Hitachi Payments has also received Reserve Bank of India's in-principle approval to operate as a payments aggregator, entities that processes payments for merchants. Rustam Irani, Managing Director at Hitachi Payment Services, is with us today to talk about the evolving dynamics of digital payments vis-a-vis cash transaction. Mr. Irani, welcome to the show.
Thank you, Manojit. Thank you for having me.
The number of ATMs have not grown in the last 3 years from the pre-pandemic levels and now. Now that the pandemic is behind us, are you seeing increased demand from banks for ATM installations?
It's actually a good question to ponder upon, Manojit. If you look at pre-pandemic and post that, yes, the number of ATMs has not increased much, while it has increased by, I believe, over 10,000. The reasons are many. One, of course, is the fact that during and post the pandemic, there has been a lot of focus on digital, and that has resulted in some amount of slowdown in terms of ATM deployment. Having said that, I think that some of what we see as a potential slowdown in number of ATMs being deployed is also due to the fact that there has been a consolidation of some of the PSU banks, number one. Number two, if you look at the growth, there is a larger number of ATMs being deployed by white label ATM operators, primarily in the Suru area, as we call it, the semi-urban and rural areas, which, by the way, is also where ATMs are most needed, given that in the rural areas particularly, financial inclusion is always a challenge. So to answer that question, in a nutshell, yes, the number of ATM which we've seen a growth has slowed down. But in terms of where it is being now deployed, I would think that in the Suru areas, which is where it is now being targeted, that's a very good thing.
But now that pandemic is behind us, do you think increasing demand from banks, or they are still not very keen to deploy ATMs?
The way we look at it, Manojit, is that there's definitely a big need for financial inclusion. And when we talk about ATMs, that's probably the easiest or the ones which people most identify with in terms of being able to get certain financial services, starting with the very basic cash withdrawals which people need. What we also see today is that there are more and more cash recycling machines, which means that you can deposit cash as well as withdraw it. And what we believe is happening now is that banks are looking at the CRMs as potentially a replacement for the CDs, as we call it, the cash dispensers, broadly categorized under ATMs. We believe that banks have, along with certain deployment initiatives in terms of branches, definitely a need to deploy these ATMs, CRMs possibly. And this we also understand will see an uptick. I would not be able to tell you what numbers, but I can definitely tell you that white label ATM operators in India would be quite keen to deploy these. And again, like I said, particularly in the semi-urban and rural areas.
But there is a clear emphasis on digitization in the country. Do you see ATMs are still viable business model going ahead?
See, we believe that people will require to hold cash. In fact, in my view, uh, cash is going to be around for a very long time, primarily because people want to insulate themselves from glitches in technology, or there are so many areas where digital transactions may not work due to some infrastructure which is not yet reached there, or due to fluctuations in power, or in terms of data signal and so on. We believe also that when we go to the semi-urban, rural, and I keep speaking about semi-urban and rural because that's potentially where financial inclusion is or needs a boost. People are most comfortable with cash over there. They need cash to give to their resellers, they give to their vendors. So it's a big requirement. We've also seen similarly cash in circulation, which has gone up from 16 plus trillion pre-demonetization to, I believe, 31 plus trillion now. And that does indicate the comfort that we have with cash. Now, digitization at the same time has picked up very much so particularly after or during the pandemic, because people were at home, they wanted to use facilities of home delivery. E-commerce therefore took off in a very big way. There was a lot of encouragement from the government as well, rightly so. And we've seen this very, very big uptick, therefore, in digital transactions. What we have also seen at the same time is the need for cash has not gone down. And yes, there has been some impact on the number of cash withdrawals. But for banks, I would think that this is a necessity. It's less about them making money. It's more about retaining their customer base, giving them the facilities in terms of both digital and cash. And that's a very big driver because banks issue debit cards and credit cards, of course, and a need for an individual to be able to access a 24 into 7 kind of a banking environment where certain basic needs, which are cash withdrawals as well as deposits, is very much so. So we do not see reduction in this need. Will banks therefore go ahead and deploy more ATMs is something that we would need to see. I can say that there is deployment of ATMs happening, which has increased the total number deployed to 260,000, around that number. And that deployment has met with similar success in terms of number of transactions taking place. In terms of viability of ATM deployment, I think it's what we understand as a customer service. And therefore, a bank would want to invest in that primarily because you're servicing your customer. It may not be an immediate revenue driver, but without that, you also have a challenge in terms of acquiring customers.
Now that you have received the in-principle authorization for payment aggregator, what is the process now and how long will it take to get the final approval?
The payment aggregator license is, of course, RBI license, which entails all applicants to be very thorough in the processes and the systems, be very clear about how certain aspects of merchant onboarding and so on will be taken care of. So that was the first process which we completed. After getting the in-principle approval, there is a set of audit and other requirements which is required to be fulfilled by the regulator, which is a process we are going through. And we expect to complete that very shortly, post which we will be able to offer these services to our customers.
So the final approval would take about how much time you think?
I would say it's dependent on an organization, Manojit, but we believe we will complete our end of the process before the end of May. Then, of course, there are a number of other licenses which are or other actions which the RBI or activities the RBI undergoes, and that may take more time. So we will complete our end of it by May.
Thank you so much for speaking to Business Standard. It was a pleasure talking to you, Mr. Irani.
Manojit, my pleasure. Thank you so much for having me.
Rustam Irani points out that the tepid growth in ATMs in the last few years is mainly due to increased digitization and consolidation among public sector banks. He retires on March 31st, and Hitachi Payment Services has already announced that Sumil Vikamsi will take over as the new MD. Moving on. Why have floating rate bonds become a headache for the government? Bhaskar Datta explains in this report.
Over the last 10 months, the Reserve Bank of India has hiked the policy rate to tame high inflation. Naturally, the government's borrowing costs have gone up as well. Perhaps the government was not expecting a recent blowout in money markets, which has had a knock-on effect on an important segment of the centre's borrowing program. Yields on treasury bills or T-bills issued by the government have climbed sharply over the past few months due to two principal reasons: the centre's decision to announce extra borrowing through these instruments in the budget and uncertainty over the extent of future rate hikes, given that India's inflation still remains elevated. T-bills are government securities with a maturity of less than a year, which the centre issues weekly to meet short-term funding requirements. While many credit instruments and certain categories of bank loans are linked to T-bill yields, some of the longer maturity borrowing instruments of the government are also benchmarked to them. These instruments are called floating rate bonds or FRBs, which typically act as an inflation hedge for investors, similar to the Treasury inflation protected securities issued in the US. They act as an inflation hedge as the yields or returns go up when inflation rises. When inflation goes down, the yields on floating rate bonds drop, implying price gains for investors. Over the last few months, however, the rise in the yield of Indian floating rate bonds has been so sharp that investors have suffered huge losses on their bond portfolios. Recently, the RBI said that accounting for the relevant T-bill yields, the interest rate on the 2033 floating rate bond of the government would be 8.51%, much higher than the previous rate of 7.42%. By comparison, the yield on the regular 10-year benchmark is at 7.31%, much lower than the floating rate bond. In fact, none of the liquid regular government securities are anywhere close to the 8% mark. Based on the RBI's formula, the other two FRBs the government regularly issued last year, the FRB 2028 and the FRB 2034, would also see their interest rates surge. The likely rate of interest for the 2028 bond is 7.91%, while that for the 2034 bond is 8.25%. This is far above the prevailing rates on the rest of the sovereign bond yield curve. In the current financial year, the government issued 30,338 crore rupees worth of the three floating rate bonds. Bond market participants have recently told the RBI that the government should cease the issuance of FRBs in the next financial year. While their inputs were based on the lack of appetite after racking up huge losses in the current year, it seems that from the government's perspective, too, avoiding the expensive option of floating rate bonds would make sense.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Bhaskar's report suggests that the government could avoid issuing floating rate bonds. In our next segment, our consulting editor Tamal Bandyopadhyay joins us to discuss the latest book to hit the stands, Money, a Zero-Sum Game, and his take on the upcoming monetary policy. Hi Tamal, welcome to the banking show. This week's column that you've written talks about a book by Krishnamurthy Subramaniam, and he's obviously the youngest chief economic advisor and now the ED at International Monetary Fund. Why did you write sort of a book review in this column this time?
Well, yeah, it's a tricky question. No, I mean, I do write interesting books. I do review in my column. It's not that I was, there's a dearth of any subject, but I thought, let's do that. And Krishnamurthy is a co-author. He is not the sole author. And that's actually, this book talks about the entire monetary system. And it challenges the conventional theory of, the dominance of central bank, the creator of money, the controller of money, which ensures the quantum of money in the system, the so-called M3. I'm not getting into the technicalities and the economic theories and all, but he says, look, that's not the case. It's the commercial banks which are more important than the central bank, and which is why he's challenging the Reserve Bank of India rules of reserve requirement, like CRR, cash reserve ratio, part of money the banks need to keep with Reserve Bank of India, and other stuff. He says, look, it's the commercial bank which gives the credit, and the credit actually generates money in the form of deposits, and then one leads to another. So that's the kind of, it's something interesting, but as I mentioned, it's not exactly new. There have been papers which challenging the conventional economic theories of the dominance of central bank in money creation. And both sides to it. There have been earlier papers on a similar line, but he has doing it's a bit of an epic, I would say. He has gone into entire money creation, the history, and the role of commercial banking, and it ended that if India wants to become a 5 trillion economy and wants to become bigger, the banks need to play a much larger role.
We are a week away from the monetary policy, so would love to get your view into what are you expecting the RBI to do? Do you think the RBI will hit the pause button?
I was dreading this question. And yes, between now and the policy, I don't think there is new set of any data which will influence Reserve Bank of India policy, because if you see the global central bankers, whether it's ECB, Bank of England, and of course US Federal Reserve, everything is over, and we found the crisis in Western world. That's the context. So it's a very close call, I would say. I would like to believe this will be the toughest policy for RBI governor. Thus, since he started raising the policy rate May last year, so from 4% to 6.5%, we have come. And as we speak, it's vertically divided. I think the economists. I understand that Reserve Bank of India governor had his pre-policy meeting with the class of economists. There also it was a divided rule. Some economists are in favor of hike. Some economists are against hike. So why do you go for a rate hike? At this point of time, the systemic liquidity is far less. It's less than 1% of GDP. It will go only further down. So yes, you stick to the stance of withdrawal of accommodation, and tight liquidity will play the role of the tightening part. You don't need to go for a rate hike at all. Give it a pass. And if you need to have it, then you go for in June. And the third option, as I said, go for a rate hike, but don't go for 25 bips, go for probably 10 bips. So from 6.5 to 6.6. Now, what purpose does it serve? It only serves the purpose that RBI demonstrates its resolve to fight inflation, the inflation fighter image. So you do that, and you continue with your withdrawal of accommodation policy, and then move ahead. And in future, you change the stance to neutral, and then depending on the situation, you can go for rate cut or continuous pause. So as we speak, 1 week before, I think all three possibilities are on the table.
You've laid out all the scenarios that RBI could go for, while also very subtly making the suggestion of what it should perhaps do. Keeping in mind there are pockets of slowing economy, and we need to push the credit offtake as well. Thank you so much, Tamal. That was great insights that you shared with us today. See you next week. This time, the monetary policy will be a tough call for RBI, and Tamal has laid down all scenarios in front of us. We will also ask you for your take on the subject, but before that, last week's poll. We asked you, are you advancing your LRS payments before July 1st? 64% of our respondents said yes and 36% said no. We are 1 week away from the monetary policy of RBI. And amid growth and inflation challenges, there is a lot of speculation on whether the central bank will hit the pause button on rate hikes. This brings us to the poll question for this week. Do you expect RBI to increase interest rates or not? Our polls open tomorrow, that is Friday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.